Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Viking Therapeutics.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick reminder, you can find the VIP Algos link right below in the description.
Yeah, definitely check that out. It's, a really great tool for tracking these kinds of market setups.
Totally. So imagine you're building a new business, right? Over the last 3 months, your company has brought in exactly $0 in revenue.
Not even like a slight dip.
Yeah.
Literally zero.
Right, absolute zero. But in that exact same 90-day window, you somehow managed to burn through more than $150 million in cash.
Which is just wild to even think about.
Yeah, I mean, by all traditional laws of finance, Wall Street should treat this company like a toxic asset. Investors should be, sprinting for the exit.
Oh, absolutely. They should be terrified.
But instead, this company is currently one of the most coveted, highly valued properties in a $150 billion industry. So today we are looking at Viking Therapeutics.
It really is, like the ultimate financial paradox.
It is. And whether you are actively managing a stock portfolio or, you're just trying to wrap your head around this massive cultural wave of modern obesity drugs, this is a total masterclass in market psychology.
Yeah, because if you look at this through the lens of a traditional value investor, a company setting fire to that much cash with no revenue is a textbook cautionary tale.
Right, it's a giant red flag.
Exactly. But biotech requires a completely different analytical framework. It shows us how the market is willing to just entirely ignore current profitability if the scientific pipeline promises a monopoly on the future.
Okay, let's unpack this. We really need to look under the hood at the raw numbers first.
Yeah, the fundamentals.
Right. So looking at the data for the first quarter ending March 31st, 2026, Viking reported a net loss of $158.3 million. Yeah. That breaks down to a loss of $1.37 per share. And put that next to the same quarter just 1 year prior, so Q1 2025.
What was the loss back then?
It was $45.6 million. So that is a staggering year-over-year jump in capital destruction.
It is. And, when you see a loss triple in a single year, your immediate instinct is to look for gross mismanagement.
Oh, for sure. You think someone is embezzling or something?
Right. But if we connect this to the bigger picture, the driver of that loss is entirely concentrated in research and development.
Oh, okay. So it's not administrative bloat.
No, not at all. Their R&D expenses skyrocketed from $41.4 million in Q1 2025 up to $150.2 million.
That is a massive leap.
It is, but you have to reframe this narrative. This isn't reckless spending. It is an aggressive, absolutely necessary scaling of operations to fund their Phase 3 Vanquish trials.
Okay, the Vanquish trials, those are the final proving ground for their flagship obesity drug, VK2735, right?
Yes, exactly.
But help me out here. How do you physically spend $150 million on research in just 3 months?
Well, moving from Phase 2 to Phase 3 in a clinical trial is basically like moving from building a prototype in your garage to opening a global manufacturing plant.
Oh, I see. So the scale is just entirely different.
Completely different. You aren't just testing a few dozen patients anymore. You have to recruit thousands of participants across multiple clinical sites, sometimes all over the world.
So you're paying for all those doctors, the facilities.
Exactly. Constant medical monitoring, massive data collection infrastructure, regulatory compliance teams, and manufacturing the clinical-grade drug at scale.
All to prove to the FDA that the drug actually works safely across a huge population.
Right. And in the obesity market, which is projected to hit $150 billion by 2030, the financial barrier to entry is just astronomical. You cannot afford to be timid.
I hear you, and I understand the necessity, but I have to push back on the sustainability of this model.
Okay, go for it.
I mean, is this burn rate not a ticking time bomb? Think about it like building a billion-dollar mega casino in the desert.
Oh, that's a good comparison.
Right. It costs an absolute fortune up front. You have to pour the concrete, build the hotel towers, install the gaming floors.
Hire all the staff before you make a dime.
Exactly. You are hemorrhaging cash every single day of construction, and you make absolutely nothing until the doors finally open.
Right. The revenue is entirely delayed.
So what happens if construction gets delayed and they run out of money before opening day? Burning through roughly $103 million in cash in a single quarter feels like walking a tightrope without a net.
Well, the casino analogy is perfect for illustrating the risk, because if the cash dries up, you're left with an empty shell. But this is where Viking's specific financial defense comes in.
They have a safety net.
A huge one. They are not living paycheck to paycheck. As of March 31st, 2026, Viking is sitting on a war chest of $603 million in cash and short-term investments.
Okay, wait. So even at a burn rate of over $100 million a quarter, they actually have an established runway.
Precisely. They can theoretically operate for another year and a half before hitting zero.
So they don't have to immediately go back to the public market to raise funds.
Exactly. They don't have to issue new shares,
Yeah.
which would dilute the stock for current investors. They have the capital in hand to reach the finish line of these vanquish trials.
Okay, so having the cash to keep the lights on is one thing, but that brings up a much larger question.
Which is?
Why are investors so convinced that Viking's specific drug is worth this massive bet? We are talking about an obesity market where giants like Eli Lilly and Novo Nordisk already dominate.
Right. The incumbents have virtually unlimited resources.
Exactly. So how does Viking compete with that?
Well, breaking into a sector dominated by pharma titans requires a deeply entrenched competitive moat. You can't just show up with a clone of what's already out there.
You need a better mousetrap.
You need to solve a fundamental problem the incumbents haven't figured out yet. What's fascinating here is Viking's pipeline and the science behind VK2 735.
Okay, so it's a dual GLP-1 and GIP agonist. We hear GLP-1 constantly in the news, but what does a dual agonist actually do?
Think of the body's metabolic system as a complex climate control system. GLP-1 acts like a thermostat for your appetite.
So it tells your brain you're full.
Right. It slows down gastric emptying, so food stays in your stomach longer, and signals the brain's satiety center. GIP, on the other hand, is like tuning the efficiency of your cellular engines.
Interesting. How so?
It improves how your body secretes insulin and handles sugars. So by creating a dual agonist, Viking is attacking weight loss from two distinct, synergistic biological angles.
Okay, that explains the efficacy, but the incumbents also have really effective drugs. The real differentiator seems to be how Viking is packaging this chemical.
Yes, the delivery methods are key.
Because they are developing VK2735 as a standard weekly subcutaneous injection, but they are simultaneously developing it as an oral pill.
And the biological engineering required to put these peptide drugs into a pill is notoriously difficult. Stomach acid usually destroys the active ingredients.
Right, before they can even enter the bloodstream.
Exactly. So if Viking has actually formulated an oral version that works, that alone is a massive achievement. But the true genius is that the active chemical ingredient in both the injection and the pill is exactly the same.
Wait, why does matching the active ingredient matter so much? If I take a shot from one brand and a pill from another, doesn't it achieve the same thing?
It comes down to side effects and the biological friction of switching therapies. When patients hit their target weight on an injection, they usually want to transition to a less invasive maintenance routine, like a pill.
Sure, nobody wants to take injections forever if they don't have to.
Right, but currently, that requires switching to a completely different chemical compound. And when you introduce a new metabolic drug, patients frequently suffer severe gastrointestinal distress.
Oh, like nausea, cramping, that sort of thing.
Exactly. Their body basically freaks out trying to adapt to the new chemical architecture.
Oh, wow. Okay, so by offering both forms using the exact same active ingredient, Viking is essentially creating an Apple ecosystem approach to weight loss.
I love that comparison.
Yeah, think about it. Apple gets you to buy the iPhone, and then the transition to the watch or the laptop is completely frictionless because it's all built on the same operating system.
Right. Your digital life doesn't skip a beat.
Exactly. Viking is doing that with human biology. They onboard a patient with the highly effective injection for maximum weight loss and then just slide them over to the daily pill for maintenance.
And the patient's body never has to adapt to a new chemical operating system. It drastically reduces the friction of long-term care.
That is a brilliant strategy. They aren't just selling a drug, they are selling a seamless, multi-year weight management life cycle.
Which directly challenges the incumbents.
Okay, but if this dual agonist strategy is the golden ticket, why are they spending even more of their cash spinning up a phase 1 trial for a completely different drug?
You're talking about VK319.
Yeah, the amylin and calcitonin receptor agonists. Aren't they stretching their focus too thin?
Not at all. They are actually building a secondary moat, anticipating a future bottleneck. You see, while GLP-1 drugs are incredibly effective, a certain percentage of people simply cannot tolerate them due to chronic nausea.
Oh, right. So they need an alternative.
Exactly. Amylin is a completely different hormone that promotes a feeling of fullness through different neural pathways. By developing this, Viking ensures they have a proprietary alternative for patients who bounce off GLP-1 therapies.
Ah, So it proves to investors they are building a comprehensive portfolio, not just a one-trick pony.
Exactly. And because they've constructed this deeply interconnected scientific moat, Wall Street is aggressively pricing in their future success today.
Which brings us to the stock's technical performance. The tape on this is wild. Viking stock recently surged 8.83% in a single day, closing at $42.13.
That is huge momentum.
Yeah, it puts it within 2.4% of its 52-week high of $43.15. It's up over 37% in the last year, and trading volume is running 1.55 times higher than the 3-month average.
People are buying with serious conviction. And the broader market context makes that price action even more revealing.
How so?
Well, look at the quantitative data. Viking currently has a beta of 0.64. Beta measures a stock's volatility relative to the overall market.
So beta of 1 means it moves in sync with the market.
Right, and a beta of less than 1 implies the stock is historically less volatile and less sensitive to broad market swings.
But the broader market has been incredibly volatile lately. We've seen a massive macro chip rout, a huge sell-off in semiconductors that dragged the whole NASDAQ down.
And yet, Viking completely decoupled from that trend. While tech was bleeding, Viking was rallying.
That is fascinating.
It tells you that Viking's price movement is completely idiosyncratic. It isn't being pulled around by macroeconomic fears about interest rates. Investors are trading it based purely on its internal clinical catalysts.
Because people will seek out weight loss solutions regardless of whether the economy is in a recession.
Exactly. It acts almost as a defensive growth asset in a turbulent market.
Here's where it gets really interesting, though. It's not just retail traders driving this volume. The insider buying metrics are absolutely flashing green.
Oh, yeah. The insider data is incredibly bullish.
Over the last 90 days, insiders at Viking, we're talking executives, scientists, board members, have purchased 190,000 shares of their own company.
With exactly 0 sells.
0 sells. That results in a max single-day purchase ratio of 100. So I have to ask, is this purely confidence in the science, or does this validate the incredibly loud rumors that Viking is about to be acquired?
Well, insider flow is generally considered the ultimate lie detector for a clinical stage company.
Because they actually see the unreleased data.
Right. Now, we have to be clear that acquisition rumors are strictly unconfirmed market chatter, but the underlying logic driving those rumors is sound.
Look at the board in front of Eli Lilly or Novo Nordisk. Viking has a differentiated pipeline that directly threatens their market share.
And Viking has a clean balance sheet, plus a market cap that a pharma giant could comfortably absorb.
It's the classic buy your biggest threat before they become a monster strategy. If you're an incumbent, buying Viking secures your dominance in the oral pill space.
Precisely. And that max single-day purchase ratio tells us management believes the current stock price does not fully reflect their value. They are putting their own wealth on the line.
Okay, before we crown Viking the undisputed heavyweight champion, we have to transition to the bear case.
Always important to look at the downside.
Right. I want to play devil's advocate here because the valuation models are wildly contradictory. Simply, Wallcent pegs Viking's fair value at $92.72.
Which would mean it's heavily undervalued right now.
Yeah, but their discounted cash flow model, the DCF, prices the exact same stock at a mere $14.06. I just can't get past this chasm.
It's a massive spread.
If I'm an investor listening to this, how on earth am I supposed to trust a $92 price target on a company that hasn't sold a single pill? It feels like that model is pricing in absolute perfection.
This raises an important question, and it highlights the fundamental flaw in how traditional risk models analyze clinical stage biotechs.
How do you mean?
Well, a DCF analysis attempts to figure out what a company is worth today by estimating all future cash flows and discounting them back to present value.
But they don't have any current cash flows.
Exactly. Standard DCF models rely on predictable revenue streams. Because Viking has 0 revenue, the model essentially breaks down.
So it's basically forced to guess. It has to invent a probability of FDA approval, guess the retail price, guess the manufacturing margins.
It's an entire mathematical structure built on a foundation of assumptions. The $92 fair value is the blue sky scenario.
Assuming the Vanquish trials succeed brilliantly and the oral pill works flawlessly.
Right. While the $14 DCF valuation acts as an anchor to reality, it highlights the gravity of the binary clinical risk.
Let's clearly define that binary risk, because this is the cliff the company is walking on. They're burning over $100 million a quarter.
And if there's a single major safety signal in these phase 3 trials,
like unexpected cardiovascular issues or horrible gastrointestinal problems.
then the entire bull thesis evaporates overnight. And it doesn't even have to be a safety issue. It could simply be an efficacy miss.
Meaning the drug is safe, but it just doesn't cause as much weight loss as the Eli Lilly drugs.
Exactly. If the numbers aren't statistically competitive, the market will instantly punish the stock. The scientific moat vanishes.
And if they hit that kind of clinical snag, that $603 million cash pile is going to drain rapidly. Fixing regulatory issues takes years.
And time is incredibly expensive in biotech. If a pre-revenue company runs out of cash while the stock price is plummeting, they only have one survival mechanism.
They're forced to raise capital through highly dilutive equity offerings.
Yes, they'd have to issue millions of new shares and sell them at depressed prices just to keep the lights on.
Which would permanently crush the equity value held by the current shareholders. So that $14 DCF valuation is a stark reminder of what happens if the science fails. So what does this all mean? Synthesizing all of this, we have massive potential upside, terrifying downside risk, and insider buying suggesting extreme confidence. What is the immediate horizon here?
The stock is behaving with such intensity right now because the catalyst calendar is incredibly dense over the next few months.
Right, starting with the Q2 2026 earnings report coming in August.
Which is when Wall Street will aggressively scrutinize that R&D burn rate to ensure the cash runway is holding up.
But the main event, the binary catalyst everyone is waiting for, arrives in the third quarter of 2026.
Yes, the top-line data readout for the VK2735 maintenance dosing study.
That's the data that proves whether the Apple ecosystem strategy actually works in humans. Does the oral pill maintain the weight loss without massive side effects?
Exactly. If that Q3 data is overwhelmingly positive, it validates the company's entire strategic thesis.
Shifting the market's valuation model aggressively toward that $92 projection.
Right. Given the company's status as a premier takeout target trading near its all-time highs, the risk-reward skew currently heavily favors holding a long position through these upcoming data readouts.
Assuming you understand the binary nature of the risk, of course. For our final verdict, the outline gives us an 8 out of 10 bullish score for the long-term view, strictly based on the pipeline's potential.
It really is setting up to be a fascinating quarter.
It really is. And as we wrap up, I want to leave you, the listener, with a final thought to mull over. We've used terms like biotech and pharmaceutical company today.
Sure.
But look at the trajectory of these GLP-1 drugs. They are transitioning from medical novelties for acute conditions into everyday lifestyle maintenance pills.
Meant to be taken by tens of millions of people for the rest of their lives.
Right. So when a daily weight maintenance pill becomes as ubiquitous as your morning cup of coffee or a daily vitamin, are we even looking at traditional pharmaceutical companies anymore?
That's a great point.
Or are we witnessing the birth of the 21st century's most lucrative consumer packaged goods empires? Think about how that paradigm shift completely rewrites the ceiling on what a company like Viking Therapeutics is truly worth.
It really changes everything.
It does. Well, if you found our analysis useful today, please consider subscribe, like, and comment underneath. And don't forget to check out the VIP Algos link below in the description to help you navigate these volatile plays.
Thanks for listening, everyone.
We'll catch you on the next one.